This is the second of two videos with Mayukh Poddar on navigating your portfolio in today's inflationary and volatile environment. Hello everyone, and thank you very much for joining us on Wealth Matters for Physicians by Altfest Personal Wealth Management. I'm Mike Prendergast, a director of Altfest's healthcare practice group and the host of this channel, which focuses on providing key investing and personal financial planning insights to help physicians achieve their important financial and life goals. In this video, we'll discuss how to navigate your portfolio in today's environment of high inflation and the Ukraine crisis. We'll dive into how the US economy is doing right now, what factors are causing inflation to rise to the highest level in decades, why now having a traditional stock and bond portfolio might not be the best way to go, and what types of investments we think are currently good for portfolios given the present volatile and inflationary backdrop. Before we introduce today's guest, a few words about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal financial lives in a fully objective, fee-transparent manner, while as a fiduciary always putting their best interests first. We are honored to be the preferred wealth manager for members of the Medical Society of the State of New York, the preferred wealth management education provider of both the New York chapter of the American College of Surgeons and the New York State Society of Orthopedic Surgeons, and a corporate partner of the Medical Society of New Jersey, amongst other associations. Our guest today is my colleague Mayukh Poddar. Mayukh is an investment strategist and portfolio manager at Altfest Personal Wealth Management, where he focuses on managing and enhancing Altfest's active investment strategies. He's also a member of the firm's Portfolio Action Group, which sets the investment strategy for client portfolios. Before joining Altfest, Mayukh was a proprietary trader at RBC Capital Markets and a founder of his own firm, which advised hedge funds and money managers on high-risk adjusted return strategies. Mayukh has also worked at Goldman Sachs and D.E. Shaw and has both an MBA and a master's in computational finance from Carnegie Mellon University. So thank you very much, Mayukh. That's very interesting what you've said about alternatives in terms of how they can potentially help balance or help reduce the volatility of the portfolio in today's markets. So for our physician audience, could you tell us a little bit about what alternatives are? And I know you've done a lot of work in what's called absolute return strategies, and maybe explain a little bit about what that is as well.
Sure. So broadly speaking, alternatives is really a huge asset class. It encompasses a lot of different things. So you have your private investments like private equity, you have venture capital, which are both fairly risky investments. Then you have physical real estate or other real assets like infrastructure assets, which are slightly less risky alternatives. And then you have strategies that are like bond alternatives, which are very low risk in the sense that they try to maintain a very low risk profile and generate returns. So I think, but the thing that kind of unifies all of that, or traditionally how we think about alternatives, is that these are assets that have low correlation to both equities and bonds. So essentially, they are not going to behave exactly like equities or like bonds. They're going to behave differently. So if when equities and bonds zig, they might zag. So essentially, they are products that are built in a way that have low correlation to your traditional holdings in your portfolio. Mm-hmm. So they bring in a diversification benefit. And then we can go into like different kinds of constructs of what kind of alternatives are good for a certain economic environment. The kinds of alternatives that we like are the ones that have some ability to hedge or provide downside protection. That might be through using explicit hedges that do well when the markets go down.
Right.
So that can provide a cushion during those periods. Or it could be using various other techniques like absolute return strategies. So briefly, absolute return strategies are strategies that try to generate positive returns both in up markets and down markets. So essentially, they are not trying to generate returns by taking market bets. What they're trying to do is generate returns by looking at, maybe it's looking across the market and seeing what are attractive opportunities and what are not so attractive opportunities. So they might actually be in a long short portfolio where they hedge out some of the market risk by going by the short side of their book, and then position themselves for more attractive opportunities on the long side of the book. And if the bets pay out the way they anticipate, then they're able to generate positive returns even if the market goes down. There are also hedge strategies that fall into this category where you can use options or other explicit hedges to hedge down the downside risk. So essentially, you're trying to generate a returns stream that isn't really driven by the market's movements, but rather driven by either idiosyncratic opportunities within the marketplace or macro opportunities across different assets in the marketplace.
Okay. So we've been talking a lot about inflation, and you've touched upon this, in certain ways, but asking you directly, what type of investments generally do well in periods of inflation?
Yeah, so I think if we talk about assets that do well during periods of inflation or have historically done well, the first thing that one has to consider are what you call real assets. Assets that are, so typically when you talk about stocks or bonds, they are what you call financial assets. They're claims on financial streams of financial cash flows.
Mm-hmm.
Real assets are assets that kind of you're holding underlying maybe real estate, plant, property, equipment, or some kind of infrastructure. So really, these are assets that as money devalues, their value holds up better, and that's why they provide inflation hedge. So what are kinds of real assets? So first of all, we know commodities, especially in periods when inflation is driven by commodity price increases, like what we're seeing right now, like crude oil prices, natural gas prices, all of them are going up. So commodities, metals, minerals, grains, so all of them form part of the commodities basket, and they generally tend to do well during inflationary spikes. Now, there are different ways to access the commodity markets. The most common way is to use, because physical commodities are hard to access because
Right.
you have to store them and take care of them.
Right.
So the most common way is to use financial contracts called futures, or funds that use futures. And then the next way is to use commodity producers. It would be like Exxons or Chevrons in the energy space, or someone like Deere in the agriculture space, or you can take any of the metal or mining producers, mineral producers. So all of those fall into the bucket. Then we can talk about inflation protection bonds. So inflation protection bonds are actually directly guaranteed by the US Treasury. They're like treasury bonds. And the way they work is that suppose you buy $1,000 worth of inflation protection bonds, and inflation this year turns out to be 8%.
Right.
So what the treasury is going to do is that they're going to mark up your principal by 8% to $1,080. So essentially there are guarantees that whatever is the increase in CPI, your principal will go up by that amount, and it's guaranteed by the treasury. So they're a really low risk way of ensuring that your wealth is protected from inflation. Then we can talk about real estate. So real estate, you can think about it in two different ways. As inflation goes up, the value of real estate properties go up, so that provides protection for inflation. Or suppose you hold REITs that hold apartment buildings. So as inflation goes up, the rents go up along with inflation. So your income is protected from that inflation, and that provides inflation protection. Finally, I think it's also important to talk about equities, because equities are also a kind of real assets in the sense that if you're in a period of inflation, prices are going up, the businesses are actually then increasing the prices they charge consumers. They're passing through the price to the consumers to the extent they're able to. That means that their earnings actually have the ability to keep up with inflation. And thus, equities can also be, in certain scenarios, be good assets to hold during periods of inflation. But obviously, one has to consider whether the kinds of businesses you hold do have that ability to pass through that pricing to consumers.
Right, because I know, as you've said before, sometimes if companies try to increase prices too much, then consumers might start to seek substitutes to avoid paying those higher prices.
Absolutely. So it's very important to understand what kind of businesses within equities we invest in as inflation hedges.
Excellent. Okay, so Mayukh, can you tell our audience a little bit about some of the characteristics that you're looking at when you're trying to identify good stocks or bonds or alternative investments, not the specific investment, but the types of things you're really looking to see if that might be a good investment for the portfolio?
Yeah, I think that's a very important question. And especially given our discussion about how we think policymakers are trying to control inflation,
Right.
that they're trying to put pressure, downward pressure on demand, which means that it's going to put downward pressure on economic growth. So at this moment, we think it's very important not only to look at assets that provide protection from inflation, but also that can withstand a slowing economic growth cycle. So both of these characteristics are important. So that's at the very top level. Now, if we think about individual asset classes, what we look for, let's say in equities. So equities, we spoke about how they have these characteristics or ability to pass through inflation costs and thereby increase their have their earnings kind of keep pace with inflation.
Mm-hmm.
But that's not true of all equities, right? So what you want to do in a scenario where Fed is tightening and we expect growth to slow down is to be careful about the balance sheet of the firms that we're investing in. We want to invest in firms that have strong balance sheets that generate enough cash internally to finance their growth needs or capex needs or whatever financing needs they have, because in a market where cost of financing is going up, we don't want to be investing in companies that are very reliant on markets for financing and financing their operations.
Right.
So we like companies with strong balance sheets that have cash flows that they can use to invest and generate growth. And obviously, we like companies that have pricing power, that are not in hyper competitive industries or sell products that people can easily substitute away from, as we were speaking about some time back. So we want companies that have products that people cannot easily substitute away from, or where in markets where they have a lot of pricing power.
Excellent.
Then if we talk about bonds, because of the Fed stance or because of the fact that interest rates are going up, we have to be careful about what maturity bonds we hold, how sensitive our bonds are to interest rate movements. We don't want bonds that are very sensitive to interest rate movements. We also don't want bonds where the credit quality is questionable, because again, in a market environment where growth is slowing, financial conditions are tightening, and the yields or the compensation you get for taking on credit risk right now, in our view, is not really high enough that we can take on that kind of risk. So our preference is to avoid high risk bonds with a lot of interest rate sensitivity risk. So keep bonds in high quality credit with less sensitivity to interest rate risk. And one of the stuff we like there is obviously inflation protected bonds.
Excellent. Thank you.
And finally, talking about alternatives, we like real assets, especially we like infrastructure assets, things like utilities, energy infrastructure, transportation infrastructure. A lot of these companies, they operate in markets where they are kind of regulated monopolies.
Mm-hmm.
If you think about utility companies, they're kind of regulated monopolies in their own geographies.
Right.
And that gives them a lot of predictability in terms of how their revenues are. And during periods of inflation, they can actually talk to the regulators and increase their rate base if they're investing in their business to keep up with the cost pressures. The same thing happens in other markets as well. Energy infrastructure markets, there are certain areas of that market where they have long contracts, they have built-in ability within their contracts to hike prices based on inflation. So, and these are businesses that typically do well during periods of slowing growth because the utilization of their services don't go down as much. So we really prefer this real asset segment, including real estate. And the other kind of assets that we prefer are absolute return strategies. So if one is careful about choosing the right kind of absolute return strategies or hedged strategies, they can actually provide a ballast during periods of market volatility. And given the economic backdrop, high inflation, tightening Fed policy, we believe that volatility is going to be high as we move through the year and into next year as well. And so it's important to have that ballast, a part of the portfolio that can actually protect the portfolio during periods of market volatility.
Thank you. So Mayukh, what are we doing, or what are we finding attractive regarding investments right now, or what are some of the investments that we're currently putting in clients' portfolios?
So, Mike, I think it will not surprise you based on our discussion so far that we're investing in infrastructure assets, both domestic and international. So that includes utilities, energy infrastructure, transportation infrastructure. Those are assets that we feel do well both in inflationary scenario and slowing growth scenarios. So we like them. We are also investing within equities. We're looking at companies with strong balance sheets and high pricing power. So really focusing more on quality aspect. So one of the areas that we like in that particular part is healthcare. Healthcare, biotechnology. Now, if you look at historically, healthcare as a sector has actually done well during periods of inflation. So that doesn't mean it's going to do well this time, but there are other things that we like about healthcare. Healthcare is also a sector that does well during periods of slower growth because it's a kind of an essential spending. That's something that consumers are not going to cut back just because the economy is slowing down, or it's going to be the last thing that they would cut back.
Right.
So their revenue streams are more resilient to economic cycles. They've historically done well during periods of inflation. And finally, they're actually very attractively valued compared to most other parts of the US markets. So that's an area that we find very attractive, and we're allocating to our portfolios in addition to infrastructure assets. Now, if we think about the fixed income part of the portfolio, we're using Treasury inflation protected bonds. And in particular, because of interest rate sensitivity, our preference is to use shorter maturity inflation protected bonds. And then on the credit side, we really like non-agency mortgage-backed securities. I know it's a mouthful.
That's a mouthful, so you might have to break it down for our physicians audience.
Sure. So these are mortgage-backed bonds that were kind of issued before the financial crisis. So some of them were bonds that really got hit hard during the financial crisis. But if you look at them today, they're actually very attractive because these are homeowners that are still holding the mortgages. So they have been paying for more than 12 years. So they have been making payments for a very long time. They have high equity built into their homes.
Right.
Employment is very strong. Wages are very strong. So credit quality in that part of the market is very high. And the yields or the compensation we're getting for taking on that risk is actually very interesting as well. And in that part of the market, there are a lot of bonds that are actually that are called floating rate bonds. Essentially, what they do is that as rates go up, as Fed raises interest rates, their coupons go up.
Right.
So there are a lot of characteristics that we like in that part of the market.
Excellent.
And finally, within alternatives, we actually run an absolute return alternative strategy in-house. And there we kind of focus on hedging out some downside risk, looking at what is attractive, what is not so attractive, and positioning the portfolio on a relative basis in a way so that the overall market exposure is not too high, but we are still able to deliver returns that are similar to an equity bond composite that people traditionally have in their portfolio. So that's also something that we find very timely and important to have in portfolios at this point.
Well, thank you very much, Mayukh, for being on the channel today. It was really great to hear your thoughts on the economy and the markets, and especially how we're using that knowledge to choose investments that might be more beneficial in our clients' portfolios today. You've definitely given our audience a great deal to think about. So thank you again for coming on today and sharing your wisdom with us.
Thank you, Mike, for having me. I think it's been a lot of fun.
Excellent. If you would like to receive a complimentary review of your investment portfolio or discuss anything related to your investments or other personal financial planning matters with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-406-0850 or by emailing Jesse at his email address, which is in the description of today's video below. If you like this video about providing insights to help physicians optimize their personal finances, please click the subscribe button and hit the bell icon below so you can receive notifications each time we release a new video. If you think that a fellow physician would find this video interesting or useful, please feel free to share it with him or her. Lastly, as always, this channel is for you, and we want to make it as useful and as enjoyable as possible. If you have topics you'd like us to cover in future videos, like or dislike certain things that we're doing, or just have any other feedback, we'd love to hear from you. So please feel free to share your comments with us in the comments section below. Thank you very much. Well, that's all for today, physicians. I look forward to being with you again in our next video. And until then, be well and keep on optimizing your finances.